Quick note, I'm starting 2 new things. 1, a TikTok. Follow me here. I'll post some behind the scenes. And number 2, I just started Meet Kevin Games. I'm gonna do some live streams where I answer some of your Q&As about investing and money while we do some games. Separate channel. Check him out, links below. Hey everyone, me Kevin here. Let's talk about David Einhorn. He's a pretty well-known hedge fund manager. In fact, in 2013, he sued Apple to get them to pay a dividend. And folks, he says that technology companies have hit their peak on September 2nd. And everything from there is going to be straight downhill. He calls tech a bubble and says that bubbles tend to topple under their own weight, especially when valuation leaves the conversation. So let's go ahead and break this down. David Einhorn just released his 2020 Q3 letter to shareholders. He runs Greenlight Capital, and he starts off by saying that Greenlight Capital has returned 5.9% in Q3 compared to 8.9% for the S&P 500. AKA somebody would have earned 3% more money investing into a low to basically no fee Vanguard index fund. Ouch. But he quickly warns us not to make fun of him. He thinks he's escaped the, quote, ranks of insanity by staying away from technology companies. In fact, he believes in a time when 34% of voters believe a civil war is likely within the next 5 years, and a post-election crisis could occur while Congress fails to find any meaningful consensus on anything, that, well, the enormous tech bubble might be the first victim of a disaster that could come after the election. He believes his company found what he thinks is the start of the tech bubble forming in 2016 and beginning to bubble and froth up over the last few years, only to now deflate and eventually pop. In fact, he goes as far as saying that investors today are just repeating the same mistakes of the 2000 dot-com bubble, saying there's no way investors should repeat those insane days, yet here they are repeating those same days. David Einhorn says that it's obvious that we're in a bubble. In fact, he points to some particular signs to suggest that we're in a bubble. The first sign is that we've got IPO mania going on, which could also be called SPAC mania, the blank check company mania. Extraordinary valuations and new metrics for valuing companies, aka traditional valuations are so expensive, so let's just use new valuations to say, it's okay to still invest. Another sign of a market bubble, he says, is huge market concentration in a single sector and a few stocks. And it's true, if you take the top 5 stocks of the S&P 500, you've got like 20 to 25% of the entire S&P 500. And how does that make sense? It's 500 companies, but the top 5 represent that much. Then he says a second tier of stocks that most people haven't heard about are all of a sudden at S&P 500 type market capitalizations. And here he's referring to companies like Nikola, which obviously has since fallen from its throne, but it happens. Then he says another sign of a bubble, the more fanciful and distant the narrative, the more it seems the stock performs. Yet another Nikola slam. Outperformance of companies, another sign of a crash or a bubble. Outperformance of companies suspected of fraud, Nikola again. Outperformance of companies suspected of fraud based on the consensus belief that there is no enforcement risk, without which crime pays again. In other words, like, hey, if the SEC ain't doing anything, why not? Crime pays well. Here's another risk of a tech bubble. Outsized reaction to economically irrelevant stock splits. Yeah, and you kind of got to give them this one, okay? There's no reason Tesla and Apple should have run up the way they did just because there was going to be a stock split. That was kooky. Even I made videos talking about that being kooky and this being a mistake before the stocks tumbled down after the splits. Increased participation of retail investors who appear focused on the best performing names. Well, okay, to him this is a sign of a bubble, and it's very common for hedge funds to bag on retail investors. But this was also disproven by the Wall Street Journal's intelligent investor, Jason Zweig. He said that, companies like Zoom were actually disproportionately held by companies that are hedge funds, not private retail investors. And he gave some other examples as well. Another sign of a bubble, incredible trading volumes in speculative instruments like weekly call options and worthless common stock. I could give him something here, okay? There's no reason for people to have bid up Hertz in bankruptcy as crazily as they did. And I agree, weekly call options, a little on the dangerous side. That's a little bit of a Robin Hood slam there. And his last sign that we're in a bubble, a parabolic ascent toward the top. Okay, well, he's got quite a few signs and opinions here as to why he thinks we're in a bubble. But he says that his best indication that we're in a bubble is this. We recently received a job application with the email subject, quote, "I'm young, but good at investments." This was an application from a 13-year-old who, quote, "purports to have quadrupled his money since February." David did not say whether or not he hired the 13-year-old. What matters, however, he says, in a bubble is market psychology, not valuation. Valuation is irrelevant, and that's what makes a bubble. So instead of capitulating and investing in American tech companies at a time when the Russell 1000 Pure Growth Index is up 15%, while the Russell 1000 Pure Value Index is down 1%, David recommends investing in the following companies. Green Brick Partners, a Texas home builder working on single-family homes. Synnex, a business-to-business customer engagement company. AMS AG, an Austrian microsensor company whose chips are often used in facial recognition because they can pick up 3D light in a better way. And NCR, this is an ATM and register company, like when you go to a store and they use a register, for point-of-sale transactions. And this is amongst other investments that he likes, like Bright House Financial, a company that provides annuities for life insurance and, unfortunately, whose stock has been on the decline since 2017. Now, I don't want to come across as dissing David here, but in an environment where Zoom has changed the world and fintechs and central banks are testing digital currencies, and in a time when many say tech has just advanced 10 years in a matter of 6 months, investing in point-of-sale terminal companies and ATM companies in a pandemic, or life insurance annuity companies, aka Bright House, and a random home builder in Texas and an aircraft leasing business seems at least a little bit antiquated. And so I think this is where we really have to think hard about what David says. Now, sure, does it make sense to invest in Hertz, a bankrupt company, or to buy a ton of weekly call options? Unfortunately, a lot of this is speculation, right? Probably not. And certainly there are a lot of high-flying IPOs with insane valuations, like the Snowflake bandwagon. And yeah, Nikola was one to stay away from. And I agree with David about those 110%. But David asks us about tech companies. Quote, "Are these companies better today? Are they growing faster?" And let me ask you this. Are companies like Apple, Etsy, Amazon, Tesla, and some of my other top favorites better companies today than they were in 2016? Are they growing faster now than they were in 2016? Ultimately, for me, I appreciated David's letter, but I'm going to stick to my guns. My current portfolio consists of a lot of tech stocks, and I like reading letters like this that are contrarian because I always like to look at what I'm missing. A lot of you know that my favorite tech stocks, by the way, you could look at them down below, or you could go to metkevin.com/1337V13. You could check those out and you can see exactly what my favorites are in the allocation. But to me, David's article here sounds a little bit more like a defense of his poor performance than a real threat to the tech sector. In fact, I prefer Robert Shiller's piece in the New York Times that we talked about on Sunday. I broke that down in detail, and if you haven't yet seen that video about a potential market crash, I'm going to link 2 videos down below for you. One, I want you to watch the video on what the most famous economist just warned, Robert Shiller. Really good video. Other creators have since copied the content in that video. Really good for you to check out. And then watch last night's video where I talked about some of my stock price targets. I even mentioned EXPI yesterday, and today it's up 14% in just one day. I'll link both of those videos down below, but let me know, what do you think about David? I mean, he's got some points about some of his bubble characteristics, but is he just sour because the S&P 500 beat him? What do you think is going on? And most importantly, have you gotten your 3 free stocks with Webull yet, and your life insurance, both of which you could sign up for in as little as 5 minutes? Make sure to deposit $100 with Webull, and folks, we'll see you in the next video.